Hey, John, that's right. The Fed just now putting out its biannual financial stability report. This looks at risks and vulnerabilities in the financial system. And the top line here is that despite all the recent volatility, the impact on these vulnerability indicators that the Fed tracks has been limited. The Fed says valuations remain high across a range of assets. That's equities, treasuries, and real estate. And that is in spite of the declines that we've seen so far this month. They say liquidity in treasury and equity markets was low and got worse in April, but they also say in the report that market functioning remained orderly. Now, total debt levels for households and for businesses remain low as a share of GDP, but indicators of business leverage, they say, are elevated. Private credit continues to grow, and the report says that a sustained decline in earnings could put some vulnerable business borrowers at risk. Delinquencies on both credit cards and auto loans also both remain above their pre-pandemic levels. Now, the banking system, they say, remains sound and resilient overall, but some banks do have concentrated exposure, they call it, to commercial real estate. Hedge fund leverage is also at or near its highest levels since 2013. And finally, John, a New York Fed survey of market participants, academics, and some others that's released as part of this report. It shows a 40-point jump in the share of respondents citing risk to global trade as a potential near-term risk to the financial system. There was also a 10-point jump since the fall in the share citing Treasury market functioning as a potential risk. Now 27% are saying that could become a vulnerability.